Welcome to the Investor Bunny Show, your go-to podcast for smart investing and financial freedom. Let's dive in.
We've got some great articles here looking at key financial metrics, the ones value investors use.
That's right. And today we're going to, unpack them.
Exactly. The goal is to make these tools feel, less intimidating and more actionable for assessing a company's real value.
Precisely. We're talking about value investing fundamentals here. Think Benjamin Graham, Warren Buffett. It's about looking past the market buzz.
Right. Focusing on the actual financial health to spot those potentially undervalued stocks.
It's not crystal ball gazing. It's about understanding the company's engine.
So we need the right tools for that. Today we're hitting the big ones: price to earnings, or PE.
Yep. Price to book, PB.
Debt to equity, DE.
Free cash flow, FCF. Very important.
And the PEG ratio, which adds a growth angle.
And we'll touch briefly on a few others too, like working capital, quick ratio, and ROE. Just the basics there.
The aim, by the end, you should feel, clearer on what these numbers mean and how they fit into evaluating a company.
Yeah, more confident in looking at these metrics and actually drawing some conclusions. Less noise, more signal.
All right, let's jump in. Price to earnings ratio, PE. What's the core idea?
Okay, PE. At its heart, it tells you how much investors right now are paying for each dollar that a company earns.
So it's price versus profit.
Exactly. The formula is straightforward. Market price per share divided by earnings per share, EPS.
Okay, so a high number versus a low number. That seems like the first big takeaway.
It is. Generally, yeah. A high PE could mean the stock's overvalued. Or it could mean investors expect really strong future growth.
And a low PE
could mean it's undervalued, or maybe that growth expectations are just lower. But here's the key thing. It really depends on the industry. Tech companies often have higher PEs than, say, utility companies. Different expectations.
That makes sense. Context is crucial. It's not just the number itself.
Absolutely. And there are limitations too, big ones.
Like what?
Well, first, are you looking at past earnings, the trailing PE? Or future estimated earnings, the forward PE.
So estimates versus actual history.
Exactly. And those forward estimates, they're just guesses, really. Educated guesses, hopefully, but they could be off. Analysts aren't perfect.
Okay. What else?
The basic PE doesn't tell you about debt or cash flow, which are, pretty vital.
Right.
Plus, a company could have a temporary dip in earnings, making its PE look really high, but maybe it's not truly overvalued long term.
So PE is a starting point. Useful, but definitely not the only thing to look at.
Precisely. A piece of the puzzle.
Can you give us an example? How might someone actually use this?
Sure. Imagine you're comparing two retailers, same sector. Company A has a PE of 25. Company B's PE is 15.
Okay.
All else being equal, which it rarely is, but let's pretend Company B looks cheaper. You're paying less for each dollar of its earnings.
Got it. Are there historical benchmarks?
Yeah, looking at the S&P 500 gives some context. Its historical PE has been all over the place. Down near 6 way back when, up over 120 during the financial crisis.
Wow, huge range.
Right. As of, say, April 2024, it was around 26. So that gives you a very broad sense of where things stand historically.
What about specific companies?
Okay, let's take some real numbers from around February 2024. FedEx, FDX, its price was about $232. EPS was around $16.85. That gives a PE of roughly 14.4.
Okay, 14.4.
Now, switch to energy. Hess Corporation, HES, had a PE around 31.6. But Marathon Petroleum, MPC, was much lower, about 7.2.
Big difference there, within the same broad sector even.
Exactly. Suggests Marathon was trading at a lower valuation relative to its earnings at that time. But maybe Hess had higher growth expectations priced in, you see.
I do. So PE is best for comparing apples to apples companies in the same industry. And always think about why the PE is what it is. Growth, risk.
You got it. And don't lean too heavily on just historical PE if the industry's changing fast.
All right. Next up, price to book ratio, PB. What does this one show us?
PB compares the company's market value, the total value of all its shares, to its book value.
And book value is?
It's basically the company's net worth, according to its accounting books. Think assets minus liabilities. What's theoretically left over for shareholders if everything was liquidated?
Okay.
The formula is market price per share divided by book value per share. And for book value per share, you usually take total assets, subtract liabilities, and intangible assets.
Why subtract intangibles, like brand value?
Yeah, things like brand, patents. They're harder to put a definite, reliable number on and might not hold their value in a liquidation. So for a conservative book value, they're often excluded. then divide by the number of shares.
Okay, so market price versus this sort of accounting-based net worth. How do we interpret that PB number?
A PB around 1 means the market values the company pretty close to its stated book value.
Okay.
Value investors often look for PB ratios below 1, significantly below.
Riza.
It could signal that the stock is trading for less than the company's net assets are worth, on paper at least. A potential bargain, maybe?
So it's like checking if the market price matches a more tangible valuation.
Kind of, yeah. Market value reflects future hopes and fears. Book value is more grounded in historical cost accounting. But remember, those book values are historical. Assets might be worth more or less now.
Right. It's not perfect current market value of the assets either. Can we walk through an example?
Sure. Let's say a company has assets of $200 billion, liabilities of $150 million. Its book value is $50 million.
Okay. 200 minus 150.
Right. If it has 10 million shares out, the book value per share is 5 all.
50 million divided by 10 million.
Yep. Now, if the stock trades at, say, $8 per share,
then the PB is 8 divided by 5, 1.6.
exactly, 1.6. The market values it at 1.6 times its book value. Is that high? Low. You'd need to compare it to other companies in its industry.
And the overall market?
Well, historically, the average PB for the U.S. market has been higher, maybe around 3 or so, but industry comparison is usually more meaningful.
Are there times when PB isn't very useful?
Oh, definitely. It's most relevant for companies with lots of physical assets, banks, manufacturers, real estate, companies where the book value is significant.
What about tech or service companies?
Less useful there. Their value is often tied up in intangibles, software code, brand, user networks, things that don't show up fully or accurately in book value. A low PB for a software company might not mean much.
Okay, so key takeaway for PB. Good for checking market price against net asset value, especially for asset-heavy businesses.
Yeah.
But consider the business type.
That's the gist. And remember, a low PD in a struggling industry might just be a warning sign, not a value opportunity.
Got it. Okay, next. Debt to equity, DE ratio. This sounds like it's about risk.
It absolutely is.
Yeah.
DE tells you how a company funds itself, how much is financed by borrowing the debt versus how much comes from the owner's stake, the equity.
Calculation.
Simple division again. Total liabilities divided by total shareholders' equity.
What's a high versus low ratio telling us?
Generally, a lower ratio means less reliance on debt, more funding from equity. That's usually seen as less risky.
Makes sense.
A higher DE means the company is using more leverage, more borrowed money. Now, debt isn't inherently bad. It can fuel growth. But too much debt
Can be trouble if things go south.
Exactly. If earnings dip or interest rates rise, high debt makes it harder to meet those obligations, increases financial risk.
So it's a measure of financial leverage, how much the company is leaning on debt?
Precisely. But again, context is everything. What's high or low varies massively by industry.
How so?
Think about capital-intensive industries, utilities, airlines, construction. They often need significant assets, so they tend to carry more debt and have higher DE ratios naturally. A software company usually needs less physical capital, so you'd expect a lower DE.
Okay. Example time.
All right, company X, a software firm, $5 million debt, $20 million equity. DE is 5 divided by 20, so 0.25. Pretty low leverage.
Yep.
Company Y, construction, $50 million debt, $50 million equity. DE is 50 divided by 50, 1.0.
So higher leverage for the construction company.
Right, and that 1.0 might be perfectly normal, even conservative for the construction industry, while 0.25 might be typical for software. You need those industry benchmarks.
Any general market figures?
Well, looking across the S&P 500, the median DE might hover somewhere around, say, 0.7. But again, huge variations between sectors.
So key takeaway for DE, it shows reliance on debt financing, a key risk indicator, but always compare within the industry.
Absolutely. And watch the trend. Is DE creeping up over time? Why? That warrants a closer look.
Good point. Okay, let's switch gears to cash, free cash flow. FCF. This sounds fundamental.
It really is. FCF is the actual cash generated by a company's operations after it pays for its necessary capital expenditures.
Capital expenditures meaning?
Money spent on long-term assets,
Yeah.
buildings, machinery, equipment, the investments needed to maintain and grow the business. So FCF is the cash that's truly free and available.
Available for what?
To pay dividends to shareholders, buy back stock, pay down debt, make acquisitions, basically anything that isn't essential operating or reinvestment cost.
So strong positive FCF. That's a good sign.
A very good sign.
Yeah.
It shows the company is efficiently generating cash from its core business and has financial flexibility.
Does it tell us anything about the future?
It can.
Yeah.
Consistently growing FCF can be a really good early indicator of future earnings growth. It often suggests the underlying business is getting stronger, maybe cutting costs or increasing sales efficiently.
So look for not just positive FCF, but growing FCF.
Ideally, yes. A company might have a low stock price, but strong and growing free cash flow. That can be a classic value signal the market might not fully appreciate its cash generating power yet.
Interesting. Is there research backing that up?
Yeah, studies generally show that companies with high and growing free cash flow tend to outperform those with weak or declining FCF over the longer term. It's a robust indicator.
How would an investor use this in practice, comparing companies?
Definitely. Imagine two manufacturers again. Company A reports higher net income, but its FCF is lower and flat because it's spending a ton on CapEx just to stand still.
Okay.
Company B has slightly lower net income, maybe due to accounting rules, but its FCF is solid and increasing steadily.
So company B might actually be healthier financially.
Potentially, yes. Its ability to generate usable cash seems stronger. You might also calculate a price to free cash flow ratio, similar to PE, to see how the market values that cash flow.
Right. Okay. So takeaway on FCF. It's a critical measure of cash generation after essential spending, a strong sign of financial health and future potential.
Exactly. And look at the trend over several years, not just one snapshot.
Makes sense. All right, last of the big five, the PEG ratio, price earnings to growth. How does this add to the PE story?
It refines the PE ratio by bringing growth into the equation. We said a high PE might be okay if growth is high, right?
Right.
PEG ratio tries to quantify that relationship. Is the PE ratio justified by the expected earnings growth?
How's it calculated?
You take the PE ratio and divide it by the expected earnings growth rate. Usually that growth rate is expressed as a percentage, but you use the whole number in the calculation.
Example.
Sure. Company has a PE of 20. Expected earnings growth is 15% per year. The PEG is 20 divided by 15.
Which is about 1.33.
Yep, 1.33.
Okay, so what does 1.33 mean? How do we interpret the PEG number?
The general rule of thumb, and it is just a rule of thumb, is that a PEG around 1 suggests fair value. The PE ratio is roughly in line with the growth rate.
And below 1?
Below 1 might indicate the stock is undervalued. You're paying a relatively low PE compared to the expected growth. Could be attractive.
And above 1?
Might suggest overvaluation. The PE is high relative to the growth prospects. You're potentially paying too much for that growth.
So it helps level the playing field between high PE, high growth stocks and low PE, low growth ones.
That's the idea. It gives you a more nuanced picture than PE alone. But, big caveat.
Let me guess. The growth estimate.
Exactly. The PEG ratio is only as good as that earnings growth forecast. And forecasting the future is hard. Those estimates can be wrong.
So rely on PEG, but question the G.
Precisely. Understand where the growth estimate comes from and how reliable it might be.
Can we compare companies using PEG?
Absolutely. Let's say tech company M has a PE of 30, growth expected at 25%. PEG is 30/25 equals 1.2.
Okay, slightly over 1.
Tech company N has a higher PE, say 40, but its expected growth is also higher, 40%. PEG is 40/40, it's 1.0.
So even though company N has a higher PE, its PEG suggests it might be more reasonably priced given its faster growth.
Potentially, yes.
Yeah.
Now, if company P had a PE of 20, but only 5% growth expected, its PEG would be 25/44.
Yeah, it looks expensive relative to growth.
Exactly. So PEG helps put that PE into perspective.
Okay, key insight for PEG. It adjusts PE for growth, giving a richer valuation view, but hinges critically on the accuracy of growth forecasts.
You've nailed it. Always be skeptical of those forecasts.
Fantastic. We've covered the main 5 in detail. Now, just a quick word on those other metrics: working capital ratio, quick ratio, and return on equity.
Sure. Quick rundown. Working capital ratio is current assets divided by current liabilities. Measures short-term liquidity. Can the company pay its bills coming due soon?
What's a good number?
Generally, above 1 is okay. Above 2 is often considered strong. Below 1 could be a warning sign about short-term cash issues.
Okay. And the quick ratio?
Similar idea, but more conservative. It takes current assets, subtracts inventory, because inventory isn't always easy to sell quickly, then divides by current liabilities.
So an even stricter test of liquidity.
Exactly, sometimes called the acid test ratio. A quick ratio of 1 or more is generally seen as healthy enough, easily convertible assets to cover immediate debts.
Got it. And finally, return on equity, ROE.
ROE measures profitability from the shareholder's perspective. It's net income divided by total shareholders' equity.
What does it tell you?
How effectively the company is using the money invested by its owners to generate profit. A higher ROE usually means better performance. If ROE is, say, 16%, the company generated 16 cents of profit for every dollar of shareholder equity.
Okay, profitability and efficiency measure. That's helpful.
They're all useful pieces of the puzzle, liquidity and profitability checks.
So to wrap things up, we've dug into PE, PB, DE, FCF, and PEG, plus those quick mentions of working capital, quick ratio, and ROE.
Yep, a good toolkit for any aspiring value investor. Each ratio gives you a different angle on the company's finances, valuation, and prospects.
And the crucial point seems to be, don't rely on just one.
Absolutely not. No magic bullet. Value investing is about combining these quantitative signals with a qualitative understanding of the business itself.
Right. Management quality, competitive advantages, things numbers alone don't show.
Exactly. Think of these ratios as dashboard indicators in a car. You need to look at the speedometer, the fuel gauge, the engine temperature, not just one thing.
That's a great analogy. By using multiple lenses, you get a much clearer picture.
That's the goal, a more holistic understanding.
So for everyone listening, as you look at companies, try applying these different ratios. See what different stories they tell. What does digging deeper into these metrics reveal about a company you're curious about? This is really just a starting point.
It is. Continued learning and applying these concepts will really sharpen your analytical skills over time.
Excellent. Well, thanks for walking us through all that today.
My pleasure. Thanks for tuning in to the Investor Bunny Show. Subscribe, share, and keep investing wisely. We'll see you next time.